Hey everyone, it's Kirk here again at Option Alpha. So in this video, we're going to explain what option assignment is, basically early options assignment, and how you can potentially use automation to help reduce this risk. So let's jump right into it with the basics. I want to teach you a little bit about what options assignment is, kind of the basic process, why it happens, how it works, and then we'll go through some examples of how you can potentially identify it. And then at the end, what we'll do is we'll create an automation or walk through an automation that you can bolt onto any of your existing bots or automations and use it to evaluate assignment risk. I use it for my portfolio right now for a lot of my bots. I have this bolt on top of it, and you can use it for yours as well. So first thing, let's go through the options assignment and exercise process, just kind of the basics if you're not familiar with it. So remember, the options and assignment exercise process kind of one and the same. It just depends on which side you're on, but it's the same thing. So exercise and assignment, it's the same thing that's happening, like the same process that's going on. It just depends on what side of the trade you're on. So for example, if you are an option buyer, then what you would choose to do is you would choose to exercise your contract. This means you're going to convert the contract from the option contract to the underlying shares. Remember that option buyers, they buy the right to do this. So they can choose to do this anytime between now and expiration, right? They can choose to convert their contract from the actual contract to the underlying shares. So if you're the buyer, then what is happening in this process is you are the person who is choosing to exercise your option contract. Now on the other side, and this is where people are mainly concerned about it, typically with traders, is they're typically concerned or worried about the assignment side of it. So the other side, as an option seller, is you get assigned contracts. Remember, if you're an option seller, you are selling an option contract, you're collecting a premium, and you're giving up your right to convert that option contract, which means the other person on the other side of that trade, not that exact person, but a random person on the other side of the trade, they could exercise their contract and then assign that contract to you, which means you're forced to convert your contract to shares. So this whole process, by the way, happens through the OCC, which is Option Clearing Corp. Again, they manage it. They guarantee that obviously it's a randomized process. So this is what the kind of process looks like, just so you guys know. The option holder, in this case, the option buyer, they would send an exercise notice to their broker. They can do it usually inside their platform. They call them up, chat with them, say, hey, look, I want to convert this contract from the option contract to the physical shares. The broker then lets the OCC know through their back office. The OCC randomly chooses a brokerage that's like a member firm. That means it could choose the same brokerage firm again. It could choose a different brokerage firm. And then that brokerage firm randomly selects somebody who's short that contract and then assigns that contract. So the process is random. A lot of people think they get targeted. I see this a lot where people are like, they're targeting me. I've been assigned 5 times this week. This never happens. I assure you, it's not that they're targeting you. They're not trying to pick you out of a line. It's just that it just randomly happens. So you could be assigned. But that's kind of how the process works. So let's talk about why this happens. Like, why does this happen? Like, how does it happen? When does it happen, etc. So most of the time, if you're trading and watching this video, you're probably concerned mostly about early assignment of your option contract. That's typically the biggest issue with options traders, or the biggest fear point is like, what happens if I get early assigned? How do I mitigate that risk? Why is it even happening? So I say that most assignment happens, and I put an asterisk to all these because at the end of the day, we don't know exactly when this is going to happen. And all of these could happen out of the ordinary context of when they typically happen. But most of the time, assignments are going to happen closer to expiration. This is because the extrinsic value of the contracts are really, really low. So you're not typically going to see, although somebody could stupidly do it, but it'd be stupid of them to do it, you're not typically going to see an option buyer going to exercise their contract and assign it to you until you get really, really close to expiration, almost the last couple days of expiration or even the last day of expiration. So rarely are you going to be assigned early on a short option contract that has, for example, 30 days left until expiration. Now, I can't say for sure, guaranteed 100% that it's never going to happen because somebody could stupidly do it. But if they stupidly do it, the option buyer stupidly assigns the contract, and it is a stupid decision. I know I've said that way too much already in this video, but it is a stupid decision. They exercise the contract way too early, then it's on them. They lose all that extrinsic value, so they're not going to do it. The next thing is that most assignments occur when the option contract is in the money and has intrinsic value. So we'll go through these again so you understand. and kind of show you some examples. But again, not only is it going to be closer to expiration, but you're also going to find that these contracts are assigned when the actual option contract itself is in the money. And that's really important because you're not going to find that an option contract is assigned out of the money. Again, although somebody could stupidly do it, it just doesn't really happen because they wouldn't do that. It'd be detrimental to them financially. So an option buyer, like I said, would never exercise their contract early if it was financially detrimental to their net position. So they would never do something where they actually lost money by exercising the contract. They'd never willingly do that, okay? So again, early assignments happen because the option buyer on the other side wants to convert the option to underlying shares. And again, this is just their preference. It's their choice. It's what they bought. It's their option. They can choose to do this or not. Since this requires significantly more capital, though, because they're converting from a leveraged option contract, right, to underlying shares. So think like one option contract that maybe costs a couple $100. Now they're buying 100 shares of the underlying security, right, which could be thousands, tens of thousands of dollars. It is a significant capital position. So just remember, it really has to be beneficial for them to do it. There's got to be a fundamental reason why they want to do it, why they want to convert that over. That's kind of the why behind it. Now, the only one that I kind of left out here, and we've got other videos on this, and I'll kind of link to those in the description below, but the only other time that it could be a little wonky or weird is when you go through ex-dividend dates. There could be early assignments due to ex-dividends. Those are kind of their own special, unique situations, but you can trade around those and avoid those, especially in Option Alpha. You can avoid trading over ex-dividend dates through your trade ideas, so it makes it a lot easier just to avoid those to begin with. All right, so let's go through an example here because I think this is really important. And again, it really comes down to this kind of like framework, which is that an option contract's value, or that premium, basically the price of a contract, is derived from essentially two things. So the first thing here is intrinsic value. So this is the first broad component of an option contract's value. And the thing that I think about with intrinsic value is like, what is the value that you have in this contract if you were to exercise it today? So if you were to convert it from the contract to the shares, which is really just basically saying, is there any value between the strike price and the underlying price of the security right now? The conversion between the strike, where I'm choosing to buy or sell the contract, and the underlying strike. So this is that first component, which is intrinsic value. Is there value right now in the contract, i.e. is the contract in the money? The other component is extrinsic value. So extrinsic value, I always think of as external factors. So things like time and volatility, like time until expiration, implied volatility, these are external factors. The contract still has value because it still has time until expiration, because it still could move, right? And so these things are kind of moving all the time with the contract as the stock is going in or out of the money, and as time is decaying and volatility is changing, these things are starting to move. But again, broadly speaking, if you take the intrinsic value and you take the extrinsic value kind of in these lump sums, then what you get is the option premium itself. So the intrinsic value is actually pretty easy. We'll start here. It's actually the easiest one to calculate because it's really simple. And it just answers the question, what is the difference between the spot price or the underlying price of the security that you're trading and the strike price? And just depends on what contract you're trading. We'll go through an example here so you know. But is there any value between the strike price and the underlying price or the spot price? So that's intrinsic value. Extrinsic value, a little bit different, a little bit more fluid, but broadly speaking, it's time value. So how much time is there left until expiration? All other things being equal, if I have an option contract that has 100 days until expiration, that is way more valuable than an option contract that has no days left until expiration, or 1 day left until expiration. And again, I'll go through examples to show you. And then volatility value, option contracts on underlying securities that are super, super volatile or expected to be volatile, way more important than, or way more valuable than option contracts on securities that are less volatile. And then you do also have a little bit of interest rate risk. It doesn't impact it as much unless you're going really, really long duration in a lot of these contracts. So let's use an example here. Let's just use a long in the money call option. Let's put ourselves in the mindset of an option buyer, for example, just because you want to understand the other side of this trade. But let's just say that somebody had bought a 100 strike long call option. Okay, so they bought a 100 strike long call option. This is where the option diagram and payoff pivots, right? This is your typical option payoff diagram for a long call option. Okay, so just keep this in the back of your mind as we're going. So if I were to tell you, and I took these ones out so you don't know what they are here, okay? So I'm gonna help you kind of derive these values here because they're actually pretty easy to understand. You can kind of break them into their main components. But let me just say that the option contract we're looking at, right, like our option contract right now, our 100 strike call option is worth $2.38. So right now, the value of that contract is $2.38. There's this number right here. Now, we don't know right now what the actual intrinsic value or extrinsic value component of that is. All we know is that we know that the option contract has both of those components. So what we can do, though, is we can solve for the intrinsic value first. That's usually the easiest way to go about it because it's the easiest math. And again, remember, the intrinsic value is the difference between the spot price and the strike price. Just asking yourself the question, is there any value in this contract if I were to exercise it immediately, or if the option buyer were to exercise it immediately? So let's assume that the market price right now for this security is 102, and we have a call strike at a strike price, or a call option at a strike price of 100. So the difference between 100 and 102 is, go ahead, do the math, it's $2. So that means that if we were to exercise this contract immediately, right? We were to exercise the contract immediately, buy stock at $100 a share, and immediately sell it at the market price of 102, we would realize a $2 profit. So the intrinsic value component of this option contract is $2. That's the value we have right now if we were to exercise it. So that means that if the intrinsic value is $2, then the remaining value left over in the contract is 38 cents. This is the 38 cents that's left over to get $2 plus 38 cents, which is $2.38, which means the extrinsic value, the value attributed to time and volatility, etc., left in the contract is 38 cents. So in this example, the vast majority of the value of the contract is tied up in the intrinsic value. Now, that doesn't mean there isn't extrinsic value, there isn't time and volatility value. We still have some of that. That's 38 cents. So it's still there, but it's not the majority of the contract, okay? Let's go through another example here. So I'll turn these back to question marks, okay? Now let's do this one. You can kind of do this one in your head, pause the video, or do whatever you want to do. I'll kind of walk through it. But now we have an option contract that, let's just say we traded a different contract now. It's not the 100 strike, and now we're trading the 105 strike, okay? So instead of buying the 100 strike, earlier we bought the 105 strike. So now the contract is worth $1.39. Now, if the market is still trading at 102, the question becomes, again, as we try to answer and solve for the intrinsic value, is there any value in exercising our call option? And so I'll walk through this here with you so you understand. But if we were to buy stock at $5 or $105, and then we were to immediately sell the stock for $102, we would net a negative $3 profit. Therefore, it is out of the money. This contract is out of the money. The call option is above, the call strike is above the market price or the spot price, which means it's out of the money, which means it would be financially detrimental to us to do this. This is why option buyers are typically, I'll say they're never, but asterisk that, they could do something stupid and do this, but they're usually never going to exercise their contract when the contract is out of the money, because it'd be stupid to do it. They would be buying stock at 105 and selling it for 102 and netting a negative $3 profit. So they wouldn't do that. That'd be financially detrimental for them to do that. So the question becomes, okay, if the extrinsic value is, it's not negative, it's basically zero, there's no value to exercising the contract, right? So we don't write negative, we just say it's a big fat zero. There's no value whatsoever to exercise in the contract. Then where did this number come from? Where did this 139 come from? And the answer is that number is all extrinsic value. So an out of the money contract, the entire value is wrapped up in time and volatility. That's the only thing that it could be. The only thing giving it value is the fact that there's time and volatility left until expiration. And so as time starts to decay and we start to get closer to expiration, that extrinsic value is going to go down. As volatility contracts, extrinsic value goes down, right? There's nothing there left until at expiration. If the contract still is out of the money, then this thing goes to zero and the contract expires worthless, okay? So that's kind of an example to kind of walk through that with you here. So let me jump over here to show you an example inside of Option Alpha. So let's just take a new position here in SPY, okay? And I'm just going to do a long call option. And let's actually go out a little bit further. So we'll go out like to July 18th. This is 71 days out, okay? So July 18th, 71 days out. And right now the S&P is trading at about, or SPY is trading about 565, essentially, okay? So what we'll do is we'll do a option contract, the 560 contract right here, which is about $5 in the money, okay? It's about $5 in the money. So it's not exactly $5. You can see it's kind of moving around and changing, but it's about $5 in the money. So the value of this contract right now, because it's all the way out in July, is $2,400. So $2,478. Again, if you multiply this out by the option contract multiplier, the actual cost of this contract is $2,400. Now this is pretty interesting because the value of this contract, if we kind of break it up into intrinsic and extrinsic value, is you could basically say, and I'm using round numbers here based on where it's trading, but you could basically say that about $5 of this contract's value is intrinsic value. Because if we were to exercise this contract right now, we would buy stock at 560 and immediately sell it for 564, 565. So about $5 of intrinsic value. The leftover value is about $20 of extrinsic value in this contract. So right now, this contract has a ton of extrinsic value and only a little bit of intrinsic value. So this contract, if you were on the short side of this contract and you were a short call seller, this contract's never going to be exercised early, because what is going to happen is that if somebody was to exercise this contract early, they'd be trying to capture this intrinsic value and they would forego this extrinsic value. That option buyer is much better off just selling the contract in the open market and reversing the trade. There's no point. It's stupid to exercise the contract, okay? Now let's look at a different example. Same call option. Now let's just move it to the 0 DTE contracts, which are contracts that expire today. So watch this. Check this out. As soon as I move this contract to 0 days, this contract is going to drop in value considerably. Okay, so now we move to the 560 call option, same strike. Now it's only the 0 days to expiration option. And notice that the value of this contract dropped to 560. So again, we're using round numbers here. The intrinsic value of this contract is still about $5, right? Because we can still exercise the contract at 560, sell it in the open market at 565. The extrinsic value, the time and volatility value attributed to this contract, is about 64 cents. So let's just write 64 here. That's a terrible 6 that I'm writing. About 64 and change, or 60, 75. It's kind of moving here. So you can see that there's actually still value in this contract. And that's because it has value today. The only value left in the contract is about $60 today, hoping that the contract has some value between now and literally the end of the day at expiration. So now you can start to see those dynamics literally in play here. So if we change this thing up just a little bit, okay, and we actually go to a different one. So let's go to an out of the money option contract. So let's go up here to a 570 call option. All right, so here is a 570 call option. Again, this is a long call. Just to give you an example, think about it on the side of the buyer. You have a 570 call option and the S&P is trading at about 565. So this contract is worth 52 cents right now, about $50. Now the question is, how much intrinsic value is there? Is there any value if the option buyer was to exercise this contract? Zero. There's zero intrinsic value, right? Because he or she would exercise the contract at 570, essentially buy stock at 570, but then sell it in the open market for $5.65. That's stupid. They wouldn't do it. Hence why options that are out of the money have very, 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 very almost no risk of assignment early, right? That's one thing that we can always check for, is that is the option contract out of the money? Because if it is, there's almost no risk that it's at early assignment, right? Because they're not going to do it. There's no value in doing it. So the only value for this contract that it has right now is it still has a little bit of intrinsic and time value, or time and volatility value, this extrinsic value, and that's about 50 cents. Now, at the end of the day, this is going to go to zero, and it's just going to continuously accelerate towards zero. This is why people do zero DTE strategies, because they kind of try to play this game where they're selling contracts that are expiring and decaying towards the end of the day. And so now you can see that this contract's value is essentially just time and volatility value. So let's move this thing back out to those monthly contracts out in July. Same strike, which would be the 570, same strike out there. Now this contract out in July has a ton of value, right? And so you could ask the same question. Well, this contract's worth about $18.52. So what component is intrinsic value? You should be able to answer this pretty quickly. It's still zero. This is the craziest part about this. Again, it's still very easy to understand the intrinsic value component because you're just making an assumption or just going through it. Would they buy stock at 570 and then sell it for a lower price? No, they wouldn't do it. That'd be stupid to do. So the extra or intrinsic value is still zero, even all the way out in July. So now most of the value in this contract at this point is still extrinsic value, just the extrinsic value is way higher because the contract has a lot more time. There's a lot more time between now and July than there is between, let's say, July or, the beginning of today, May 8th, and the end of today, May 8th. That's a very short period of time, only a couple hours. But if I were to trade a contract that's all the way out into July, a lot can happen between now and then. So that contract, of course, is worth more for anybody, whether it's an option buyer or option seller. So hopefully kind of going through this example helped out just to kind of understand the dynamics that are at play here. This works the same way on the put side, just in reverse, obviously, for everything. But I hope this example kind of really helped out. If it did, let me know in the comments, okay? So next thing that we need to do here, of course, and I hope this helped kind of walking through the process of what it is and how it works and how you can kind of piece and divide these things up, because it really does help for the next step, which is how can we leverage automation? How can we use automation to identify early assignment risk? So if we know what we're kind of looking for broadly, not that it's going to be perfect, but if we broadly know that we're looking for things that are in the money and things that are very little extrinsic value. So most of the value left in the contract is intrinsic value. So there's not really a reason that an option buyer would have a financial detriment to hold the contract, right? So there's a reason why they would exercise the contract. If we can look for those two things, then we can identify positions that are at risk of early assignment. So what we can do is we can actually use a monitor automation inside of Option Alpha. Again, I've built one out for you guys. I'll show you how I use it inside of my bots. Then you can bolt it onto your bots as well. I'll have links to all these in the description below. But we're going to use a monitor automation to continuously watch our positions as they approach expiration. So this is the first thing that we're going to check. We're going to check and see, is the position nearing expiration? Now, this could be different for different people. I'll show you how I do it. But remember, as the position is coming closer to expiration, that is when the position starts to increase its risk of early assignment. All else being equal, because it's closer to expiration and it's more likely that the contract has less extrinsic time and volatility value. Then what we're going to do is we're going to determine if any positions are currently in the money or are they likely to be in the money by expiration date. Now, these are two things that we can actually assign values to. We can check and see, is the position currently in the money? That's number one. And or is the position likely to be in the money by expiration? And if those are true, then we can make some other decisions. And then what we're going to do is we're going to calculate the extrinsic value of those short option contracts, because if the extrinsic value is really, really low, there's no point in the option buyer holding the contract or reversing the trade. That's when they're most likely to assign the contract. They're most likely to assign the contract when it's in the money and the extrinsic value is super, super low. That is what we can do to determine early assignment. And then finally, what we can do is we can say if that position is defined as at risk of early assignment, however you deem that with some controls, and I'll show you how that works, then we can simply close the position early and remove the risk. This is exactly what I do inside of my bots. I've been doing this for a while now with this same automation. I tweaked it a couple times, but the one that I use right now is pretty simple. Again, you can use your own variation if you want inside of your bots, okay? So here's what I do. So inside of my bots, and I'm starting from blank slate so you guys understand how I kind of put it together and how you can do it too. Inside of my bots, I have an automation that's a monitor automation. I removed it only for now just to show you how you can add this to any bots that you're running inside of Option Alpha. And the reason that you can add it to any bots is because it is literally a bolt-on automation. I call it a bolt-on because it's meant to just simply get added to any automation and be a monitor for risk management. So let's say you have some automation that's running a scanner and you've got some positions. You want to go to Add Automation. And then what you're going to do is once you save this automation, you can save it from the post that I'll link to in the bottom of the description. What you're going to do is you're going to go to your library, wherever you save this automation. In this case, I saved it in this folder called Kirk's Monitors, and it's called Early Assignment Risk Management, and it's called Bolt-On, and I'm simply going to click on this automation, okay? And what we're going to do is we're going to schedule this to run as a monitor automation, which means it's going to monitor positions. It doesn't need to run unless the bot has positions. That's a really important point. There's no reason for us to monitor for early assignment unless we have positions. So we're going to run as a monitor automation. We're going to run it every day, and you can choose if you want to run it on up market times or not, but I'll just run it all the time. It doesn't matter. And then it has a couple inputs, and these are really the simple kind of areas that you can have for your inputs. These are super simple. Number one is the expiration day threshold. So it'll evaluate a position only when the positions are less than this number of days until expiration. So I have mine set to 5, which means essentially expiration week. So if the position is 30 days out from expiration, it's going to run the automation, but it's not going to do any evaluation for assignment risk. It's not going to touch it. It's not going to do anything because it's not close enough to expiration yet. So you could set this to something a little bit closer, like 3 market days or 1 market day from expiration. But the risk that you run in doing that is that you get too close to expiration and you start increasing your chance of early assignment risk. Again, you be you do whatever you want to do. I kind of set mine to 5 market days. That allows my bots to close positions early, really reduces the risk of early assignment pretty good. The next thing that you can do here is you can set your in the money chance. So we're going to check inside the automation, and I'll show you here in a second how we do that. But we're going to check and make sure the position is already in the money, but also I want to check and see what the chance that the short leg stays in the money by expiration. This is really important to me because I don't want to arbitrarily close a position that just happens to be marginally in the money, right? I want to make sure I'm closing positions that really do have a chance of staying in the money at expiration. So I set my in the money chance at 70%, which means if the contract the short leg of any trade that I have in this bot, if that short leg is in the money and there's a 70% chance it stays or ends in the money, that's a pretty high signal for me that there could be early assignment risk. And then the last thing that I'm doing is I'm setting an extrinsic value threshold. And here I set it for 10 cents. And what this means is that if the value of a contract the extrinsic value of that contract goes down to 10 cents or less, then that is a trigger again for me, a signal for me that I might want to close that position early. It means that there's not any time or volatility value left in that contract, which means it's the highest likelihood that you're going to get somebody to assign that contract early. Doesn't mean it's going to happen 100%. Just means you're at the highest likelihood that it happens. So if we were to go back here to our SPY example here, and we go here to these 0 expirations, and we'll go here to, I think it was the 560 calls, right? 565 calls right here. So if these contracts right now, this contract has a couple dollars. Oh wait, no, let me go to the 560. I'm sorry, 560. There we go. So let's say that this contract it's 541. And so the intrinsic value, again, we're just going to round for round numbers, is about $5. Stock is trading at about 565 and change, like right up there around $5. So the intrinsic value of this contract is $5.45 or $5. that means that the extrinsic value right now of this contract is 43 cents. All other things being equal, this contract is in the money. Maybe there's a good chance it ends in the money, but the extrinsic value is still 43.30 cents, right? So that means that there's still time value left in the contract. If an option buyer were to exercise this contract, they are forgiving and foregoing that time value. They're much better off just selling and reversing the contract in the open market rather than go through the whole process of exercising it. So this contract's not at risk of assignment because there's still some time and volatility value. But as you can see, if that extrinsic value starts to go down, and let's say it gets under 10 cents, right now it's about 22 cents, 15 cents, just again, kind of using round numbers. But if it gets under 10 cents, then that's a higher likelihood somebody's going to assign the position or exercise their position and assign you the shares because that extrinsic value is really, really low, okay? So again, inside of my automation, I can choose what these settings are, and you can choose them for different bots. The way I set up this automation for you guys is that these inputs are right here, so you can, for some bots, you can go 3 days and 90% and $10 or whatever you want. But whenever you change these, they get used throughout the automation. So we'll just set those as the defaults that I have there, and then we'll click save. And now that gets added as a monitor automation to my bot that's currently running right now. So let's take a look at this automation itself and just kind of see what this automation is doing. First thing that it's doing is it's repeating through every position that the bot has. So I'm not filtering it at any point right now. I'm not telling it to repeat through only positions with a certain tag. Nope, I want it to be as bolt-on as possible for option sellers. And so in this case, we're going to repeat through each position the bot has. Then I go through a decision that just answers or asks the question, does the position expire soon? And the way that I define it here is with this simple decision that says the position expires in less than the expiration day threshold. So in this case, it would check and see, does the position expire in less than 5 days, right? And I can actually quickly run a test for this bot that I'm in right now and see, does the position expire in less than 5 days? No, this position actually expires in 6 days. So it's not going to do anything else. It's not going to evaluate it until tomorrow, essentially. It'll start, or 2 days from now, it'll start evaluating whether the position should be closed. Now let's assume it passes this, and the answer to that question is yes for some reason, right? Now the position's close to expiration. So now what it's going to do is it's going to go through a series of questions, and those questions are going to be around what type of position it is. So in this case, it's going to say, is the position a short put spread position? If the answer to that question is yes, then it's going to go down this path and evaluate a short put spread. If it's not a short put spread, it's going to ask, is it a short call spread? If the answer to that question is yes, then it will evaluate a short call spread. And if it's not a short call spread, it'll ask, is it an iron condor or an iron butterfly? And if the answer is yes, then it evaluates that as an iron condor or iron butterfly. The reason that it's broken up like this is because those actually are different types of evaluation that you have to do for these positions. So let me go through an example so you understand. If the position is a short put spread, then we're going to ask, is the position at risk of early assignment? Now, how would we judge early assignment for a short put spread? Well, we're going to check and see if the price, the position's underlying price is below my short put strike. That means, is the stock trading at 100 and my short put is at 105? That would be an answer yes. The stock is trading at 100 and my short put is at 105. This is a very simple evaluation, but it's really powerful. What we're checking here is we're checking to see that the stock is actually in the money compared to our option contract. Remember, now there's intrinsic value. Now there's a reason someone could exercise it early, but we got to do some other checks too, right? It's not just that they're going to exercise early just because it's in the money, but they're definitely not going to exercise it if it's out of the money. So first thing we can do is check and see, is the position in the money? Next thing that we can do is we can check and see, is the position's short leg? We can actually identify just the short put leg itself. The short put leg, is the chance of that being in the money greater than my in the money chance input that I put in? So in this case, I can say, is the chance of this short put leg, the one that is now in the money, right? Is there a chance that it's going to stay in the money of greater than 70%? If the chance of it staying in the money is 50%, I'll let it ride for a little bit. That means that the stock is kind of trading right around the strike. No need to get jumpy, right? We only want to take positions off when they get really, really in the money and at high risk. The final thing that we're going to do, if this is true and this evaluates true and it's like, yes, it's in the money. Yes, there's a good chance it's going to stay in the money. Okay, great. There's one more thing that we have to do, which is we need to evaluate if the short put leg's extrinsic value, again, we can identify and evaluate through automation, just the short put leg, right, which is the one that we care about, if the extrinsic value is less than the threshold that we set. And if that's true, so it's in the money, there's a 70% chance that it stays in the money, and the extrinsic value, let's say, is 5 cents, well, then in that case, it's probably at really high risk of early assignment. Not that it's going to be assigned, but for me, I don't want to go through that hassle, so I'll tag it as early assignment risk and remove the position. If it goes through all of these are true, this and this and this, if those are all true, then what the automation does is it goes here to the yes path, and on the yes path, I've told the bot, I've given it authorization to say, go ahead, close the position. Now I do it 3 cents from the mid price, so I give it a little bit of leeway. I want to close 100% of the position. I don't want to close a certain number of contracts or whatever. And what I do for myself is I simply tag the position early assignment risk. This is important to me because I want to know when I close a position, if that position was closed due to whatever factors. If it was closed for a profit taking or reversal or whatever, I can track that and I can tag that position early assignment risk. Then I know which positions were closed for early assignment risk and which ones weren't just by looking at the actual tag. And I'll show you that here in a second. So the next thing is, if it's not a short put spread, again, it's going to evaluate a short call. In this case, it's doing the same thing. It's just looking at the short call leg and doing the analysis and seeing if the underlying price is above the short call strike, right? And for the iron condors and iron butterflies, it's doing it a little bit different because it's trying to evaluate 2 sets. So either the short call strike is in the money, right, on an iron butterfly or iron condor, or the short put strike is in the money. So it's got to evaluate both. We use an or statement with group decisions to do this. Again, it's doing the same thing, just using it as a group statement. Is one side challenged versus the other? And if one side is challenged, again, same thing happens here. We would close the position, tag it as early assignment risk, and remove the position from our account. So really easy automation. Again, it just kind of goes through the process. You don't have to do it anymore because you can let a bot do it and evaluate that assignment risk. You don't have to make those calculations, do that math. I assume that a lot of people are not doing this anyway. So if you weren't doing this before, or now you're doing this manually, now you can do this with a bot and automation. So inside of my position tab here, you can see, and I do a lot of tagging just for like stat purposes and tracking purposes, but you can see here, if I go to close positions, which positions were closed for early assignment risk. And what I find fascinating, obviously, with this too, and this is like, I think counterintuitive to a lot of people, is that just because a position is early assignment risk doesn't mean it's always a loser. Like this one, we closed for a $15 profit. It was early assignment risk, but we still actually made money on it. We're still up money on it. It didn't reach our profit target, but it was at risk of assignment. So we needed to close that position, right? And the same thing here. So this one here closed for a $92 loss, but that's okay. I'd rather take that loss, move on, than have to deal with the assignment risk. If I actually go to this, I can go to the automation itself and look at when the automation closed. So in this case, it went through the assignment risk. Is the position less than 5 days? Yes. Was it a short put spread? No. Was it a short call spread? No. Was it an iron condor or iron butterfly? Yes. And then if I looked here, this is all the stuff that it evaluated. So the short call strike was not the challenge strike. It was the short put strike that was challenged. The stock was below my short put strike. The chance of the put leg being in the money was 97.97 or 97%. So almost 100% chance that it was going to be in the money. And the extrinsic value was 3 cents. I mean, like, these are things that are really, really easy to look at now, because now you can see, yeah, duh, of course, this thing was going to be assigned at some point. Like, we're just running up against the clock. But now with this automation, I can check all of these things and then remove the position, remove the risk, and carrying on. So it's not that all of them get closed. So these ones here, they didn't get closed for early assignment risk. If they did get closed for early assignment risk, they get tagged. But you can see a lot of these don't, and it just depends on the market environment and how things are kind of trading. But once you have these in here, you can kind of monitor them moving forward for yourself. So again, I really hope that this kind of helped out today, kind of going through this option assignment process, not only understanding hopefully what it is, how it works, why people would do it with some examples, but also how you can use automation to improve that. Again, I'll give you links to all of the things that you can use here as resources right below this video. If you did enjoy this, please let me know. Please share, like, comment, subscribe to the channel so we know that we're reaching you and we can reach more people who are looking for options trading info. As always, if you need anything, let us know. And until next time, happy trading.